Thanks for tuning in to The Average Joe. Today's topic is taxes. A question that's come up recently that I've seen on many forums is, do I have to pay taxes on my earnings when investing into cryptocurrencies? The answer, yes. Bottom line, anytime you make a buck, doesn't matter how you make it, you're going to have to pay taxes. End of story. Now, where it gets interesting is that if you're asking that question, you're probably doing something you haven't done before and you want to know, okay, so I pay taxes, what kind of taxes do I pay, and how much? So let's start off first by understanding how the IRS views the ownership of cryptocurrency. In the fall of 2017, IRS basically stated that they consider cryptocurrency to be the same thing as owning property. So just like buying a house and flipping it, for instance, very similar in concept. And therefore, we can establish some rules about how the IRS views revenue generated from buying and selling and what type of tax laws go into effect. So when you buy and sell property, the amount of tax or the percentage, the tax rate, is based on how long you own that particular asset. The DMARC line is 12 months. If you buy and sell something in under 12 months, you will pay a higher tax rate, which I believe, and this is subject to change, and I may have my information wrong, but again, it's research, could be towards 30%. If you hold on to an asset and sell it after 12 months, the tax rate drops down to about 15% because they view it as a long-term asset versus a short-term asset. So it makes a big difference. However, a lot of us are buying and selling, like buying into the dip and selling when it's high, which means you're turning over a particular asset more than one time during the 12-month period, so you're going to be subject to a higher tax rate. And that's okay. Keep in mind, you always have to pay taxes. But the computation of taxes is a function of two values: the value of the asset times the tax rate. So if we establish what the tax rate is, the next question is what is the value of the asset? So if you're getting into what we call retail investing, which most people are right now, they're under the idea that I invest $1 into Bitcoin today, and at the end of the month, I get $6 back, and that's okay. You're going to be taxed on the $5 that you made because you're getting your dollar back and you have 5 left. Well, you're not necessarily going to have to pay taxes on that $5, and this is kind of what I'm coming in onto the video, which is here's some ideas on tax prep planning, mitigation, strategies. So I'm going to bring up a topic here that gets very confused with a lot of people, and they get a little nervous because they probably haven't done it before. There's two terms called tax avoidance and tax evasion. They get confused a lot. They're really two separate things. Tax evasion is illegal. People go to prison and die under tax evasion. Case in point, Al Capone. He did a lot of things that were illegal but couldn't be proven in a court of law. But they were able to finally get him on tax evasion because they got a hold of his accountant and the books and had evidence of all the revenue that he created selling liquor but never reported it as income. So he went to prison and died because he didn't pay his taxes. Forget about anything else he did. That's what they got him for. So don't mess with the tax man. Yes, you always have to pay taxes. That's evasion. Generally, to put it in very basic concepts, evasion is a function of one of two things. One is I'm not reporting all my revenue, so therefore I don't have to pay as much tax on it. Or I'm over-reporting my expenses to reduce my net revenue, and therefore I'm paying less taxes. Both of those are illegal. So that's evasion. We're not talking about evasion. We're not talking about hiding anything. Actually, the more open and honest you can be, the more legit you will be if you ever get audited. So always keep in mind you want to pass the sniff test. So what we're focusing in on is avoidance. How to take our money and properly document it so it applies to the current tax code so you can reduce your tax burden. The simplest strategy that I can offer you right now is go to irs.gov and apply for an employer identification number. And basically what you've done is set yourself up as a small business. End of story. No fee, just fill out a form and they'll send you a number in a couple weeks, and you can do all sorts of fun stuff with that, like open up a bank account. So I'll come back to that in a minute. So once you establish yourself as a business, which will probably be investing, you're now opening yourself up to a whole row of tax deductions and exemptions that you weren't utilizing before by filing your standard deductions when applying for taxes. So again, the average Joe, we're doing a 9-to-5 job, we get a W-2 at the end of the year, we fill out a 1040 and maybe do some basic itemization like our house mortgage and interest and things like that, or a 1040 EZ. You can keep doing that. Now what you'll file as well is a Schedule C, which is basically profit and loss. It's like a balance sheet of small business operations. This is where it gets fun for us. Cryptocurrencies can only be purchased online. So what does it take to do that? Well, I need an internet connection, I need a cell phone, I need a laptop or a PC, I need a desk. All these things are required to be able to purchase and sell cryptocurrency. And as such, they are tax deductible. So when we come back to, I put $1 in October and I pulled 6 out in December, you can now do things such as, well, you can tax me on those $5, but I've got $400 in internet service over the past year, so I can buy and sell and look at the charts and move things around. That's an expense, so that comes off of that $5. Then I had a laptop or a PC, and whatever those rigs cost, are cost of doing business, that you can do a direct depreciation in the first year depending on the value, or spread it over, I think, 3 years and take those deductions. And therefore, you go from $5 to $4 to $3 on taxes. And depending on where you do your small business investing, such as maybe a spare bedroom in your house, you're possibly privy to the home office deduction. So all sorts of things happen there, which is your interest, your mortgage, portion of your utilities are tax deductible. So sure, the government can definitely take a piece of the earnings you do for investing in the cryptocurrency, but at the same time, you get to take a piece of them for all the things that touch the ability to buy and sell cryptocurrency. So with that said, that's a great mitigation strategy for you, and it's not a lot of hard work to do. And as I mentioned earlier about getting an employee identification number and getting a bank account, you can get online bank accounts that don't require checkbooks. You just get an ATM card, but you still get a routing number. And as such, like I use Bank of America, I have a free business account because I already have existing accounts. The more legitimate you can make yourself as a business by having a bank account, by having an employee tax ID number, by recording your expenses and keeping the receipts, the more you will pass the sniff test in these deductions to offset the taxes you get from investing in a cryptocurrency. Now this is where I'm going to put in a disclaimer. I'm not a lawyer, I'm not an accountant, this is not legal advice or financial advice. This is just some ideas to create a plan on how to mitigate taxes. Well, that concludes this video on taxes, cryptocurrency, and mitigation strategies. Remember, evasion is illegal, avoidance, please do all you can. If you like this video, remember to click subscribe, and I'll try to put up more content as I can. Thanks for watching The Average Joe.